Well, good afternoon, ladies and gentlemen. Of course, I say good afternoon to those of you joining me here on the East Coast. I also want to say good morning to those of you joining us on the Central Time Zones, the Mountain Time Zones, or Pacific Time Zones as well. And good evening to any of you who are joining us from across the pond in parts of UK or parts of Europe. And of course, good early morning if any of you are joining us from parts of Asia or Australia. Welcome to today's presentation, part of our options investing concept series. Today, Jack says the sound is choppy. We'll just start off there. Jack says the sound is choppy. If everyone can chime in real quick and let me know if you can hear me okay, if the audio is okay. Okay, let's see here. So Todd says it's okay. David says sound okay, good. Rhonda says it's okay, fantastic. All right, so Jack, you may want to log off and then try to log back on and see if that gives you any kind of better sound there, but it looks like most of the audience here says the sound is okay, and we've got about 50 people in the room. Okay, so we're just going to go ahead, and we are recording this presentation, but again, welcome to today's presentation. Today we're going to discuss Greeks for options investors, and of course, we're going to also discuss why you may not need them, and we're going to get into that a little bit later. Now, for those of you who don't know me, my name is Mike Chupka. I'm the Director of Education here at PowerOptions. Many of you know PowerOptions, of course, is a patented suite of tools for options investors. We support over 23 of the most commonly used options strategies. In addition to the patented search and management tools for options investors, we also have various help videos, tutorials, and webinars to help you get more familiar not only with the tools on the site, but the various option strategies as well. And PowerOptions has been in business for 17 years. I've had the great pleasure of working with the company for the past 11 years. Now, for today's presentation, we're going to give a basic introduction and review of the Greeks for options investors. And we're going to focus mainly on what are known as the first order Greeks, delta, theta, gamma, vega, and rho, of course. We're going to use common terms. We're not going to get into the equations, the calculations, and the math that's involved with these. We're just going to give a basic discussion, common terms, and how they apply to your trades, essentially. And then we're also going to discuss in there application of Greeks in investing. And then lastly, we're going to show why you may not need them. It's always nice to know what they are. It's always good to know how your option price is going to be affected. But we see a lot of gurus out there that charge a lot of money to teach what the Greeks are and how to use them specifically. And what we want to show at the end of the presentation is how everything kind of works hand in hand. And if you have a solid trading plan for your investment strategies, the Greeks may not actually apply, but we're going to take a look at that. They apply, but you may not need to get stuck in the quagmire of all the terminology and everything else. But before we begin, okay, Jack says the sound is cleared up. Fantastic. All right, before we begin with what we're going to discuss today, I'm going to launch two quick polls back to back. And the first thing I would like to know from those of you joining us today is how would you classify your experience level in options trading? Are you just getting started, meaning you're getting some education, you're maybe paying for a course, you're going through a course, so you're just getting started? Have you made a few trades and still learning? Maybe you've just made a handful or so, or maybe a dozen of options trades in the past couple of years, or over the past couple of months, I should say. A few trades there. Have you been trading options for the last 12 months? So you've been actively trading maybe over the last year or so. Are you an active options trader and have been for years? Or do you think, and there's nothing wrong with that, you think you could probably teach this class? And it's okay to answer that because you may have more experience trading than I do. That's a possibility. All right, well, I've had the poll open for almost a minute. We're going to leave it open for the next 5 seconds. If you haven't voted yet, I encourage you to do so. All right, so let me go ahead. We've still got some votes coming in, but I'm going to go ahead and close that poll, and we're going to move on here. Let me share the results with everyone. So we've got a good mix, and we've got some good experience here. Only 19% of you have made just a few trades. That's fantastic. 32% of you have been trading for the last 12 months. And 48% of you are active options trader, and you have been for a few years. I'm going to follow that up with one more quick poll, and this will help us later on. It'll help me later on. But I just want to know what kind of option strategies are you mainly trading or researching right now. Are you mainly looking at covered calls and naked puts? Maybe you're just at first level qualification for options trading. Are you looking at the protective option strategies, married put trades, radioactive trades, collars, for example? Okay. Are you mainly doing option buying, buying calls and buying puts, speculating on a market movement? You're doing the vertical spreads, of course, just bear call credits, bull put credits, the debit spreads perhaps, or even iron condors, combinations of the bear call and bull put, fantastic. Or are you doing the calendar spreads, and this, of course, will include horizontal spreads, diagonals, and double diagonals as well. All right, so this poll's been open for about 50 seconds. I'm going to leave it open for another 10 seconds. We've got most of our votes in. But again, if you haven't voted, I encourage you to do so. David says he's advanced. Good. Some chimed in here. Richard says over the last 12 months, very active with a $500,000 account with Interactive Brokers. Fantastic, Richard. A couple of our experienced traders there. All right. Let's go ahead and take a look at our poll here. All right. I'm going to close that down. And let me share the results with everyone again. 61% of you are doing covered calls and naked puts. Our winner, 73%. Are doing vertical spreads, bull put credit, bear call credits. We've got 39% of you doing the protective option strategies. 42% are buying options, and this is the highest I've seen on some of my recent webinars. 33% of you are doing the calendar spreads and the diagonal spreads. I've seen this gain more popularity, of course, with the increase of weekly options. A lot of calendar spread investors are maybe buying 2 to 3 month out options or even 3 to 4 week out options and selling the weeklies against them. Okay, well that gives me a good gauge of what we're going to cover towards the end of the presentation. All right, looks like everyone's seeing the screen, so let's just start the basic presentation. What are the Greeks? Well, they're derivatives measuring the price change and sensitivity on the price of an option related to changes in, of course, the stock price. It's measured by delta. Changes in volatility, that's Vega. How will that affect your options price if volatility changes, implied volatility mainly? Theta, of course, is the measure of how your option price will be affected by the passing of time. How much can you expect to see your option price decrease over time? Gamma is the changes in delta, the delta of the delta, essentially. So we're going to show that real quick right off the bat. And then, of course, change in interest rates is measured by rho. Those are the 5 we're going to cover today very briefly. Now, how are these changes calculated? Well, the changes in the option price related to a change in another aspect of investing, stock price, implied volatility, and so forth. The theoretical Greeks, and they are theoretical, they're what the option, we expect the option should change based on a change in one of those other factors. But they're basically calculated using properties of the Black-Scholes pricing model. And the key to remember is this is theoretical. Is what should my option price change to if stock price, volatility, or time passes? This can all change. As the stock price moves up, you'd say, okay, well, my delta said my option was going to move up this price, but it didn't, because at the same time, when the stock moved up, time passed, and volatility probably changed as well. So 3 factors are probably moving at once. The pricing models do give us the best guess as to what prices should be. Other factors will always influence that. In addition to changes in the other criteria, we'll also see supply and demand. If volume starts to increase, we know the market maker is going to put a wide bid-ask spread. So we may not see the option price move as much as we thought based on the Greek factors due to a wide bid-ask spread or to other factors for supply and demand in the market. Now, just a quick review here. What is the Black-Scholes pricing model? It's a theoretical calculation that's used to determine the price of an option. What is the theoretical price of our option? 5 factors are used in the Black-Scholes pricing model. The underlying stock price, the strike price of your option, whether it's a call or a put, the days remaining to expiration, so how much time is left to pass on the particular option you're researching, and volatility. And I put an asterisk next to this because different services will measure volatility a different way. Some Black-Scholes pricing models, a service might use the 50-day volatility. Some might use the 100, some might use the 52-week volatility. So I personally get a lot of questions where investors ask, hey, I use Thinkorswim, and your volatility numbers are different from theirs. Your stock volatility numbers are different from theirs. Why is that? Well, it's because of the time frames that we're using. Okay, they tend to use a longer time frame. We typically stay with a 50-day. But I just wanted to mention that that's one of the caveats. And everyone says, why isn't the Black-Scholes number the same for every service? Well, it's because different services will use different time frames for the stock volatility. Of course, the fifth factor is the risk-free interest rates. The Black-Scholes calculations does make some assumptions, right? And many of you know this, but the assumptions that are made by the Black-Scholes pricing model, of course, are log normal distribution in the market. We know that's not always the case. It also bases the case on certain expiration qualities of the option as well. So it's a good tool to use, and the concepts, again, of some of the calculations that are used to determine the price of the option are used to calculate our Greeks. So we get a theoretical price of the option, and then we say, okay, well, if we change this, and we change the underlying stock price by $1, what would our theoretical price be? And we see it's 50 cents different, or 50 cents higher or lower. Well, that kind of tells us that the delta is about 0.50. Okay, and the same thing, well, not changing the price, but we get the days remaining to expiration. Shorter term will naturally have different calculations, or different values, I should say, for the Greeks than options that are further out in time. We're going to take a look at that as well. All right, first basic view, delta. The biggest one we probably pay attention to. The delta is what we'd expect to see the change in our options price based on a 1-point movement on the stock. Okay, 1-point gain in the stock price. Call options will have a positive delta, and put options, of course, have a negative delta. Now, the deltas are also related to sort of the moneyness of an option. For call options, those options that are deeper in the money are going to have a delta closer to 1. Okay, so if we have a 1-point movement in the stock price, we'd expect to see a 1-point movement in the underlying security. Okay, at the money options will always have a delta of about 0.5, an absolute value of about 0.5, whereas the put options at the money will always have a delta of around negative 0.5. So if I get a 1-point increase in the stock, we should expect to see our delta lose about 50 cents. And then, of course, as we go further out of the money for calls or puts, we'd expect our delta to be at 0. Here's a basic chain. We're going to use the same stock and around the same price for some of our examples today. Here we have Apple yesterday trading at 101.13. The 101 strike would be our at the money. And of course we see here that our deltas for the at the money options, the call's a little bit in the money. So we have a delta here of 0.52. For the put series, we have a delta of 0.48. It's a little bit out of the money, so we have a little bit of quality there. We have a little bit difference, a little bit under 0.50. Now calls, as we go to the lower strike prices and we go deeper in the money, we can see the increase in delta. So go to the 100, it's at 0.62, 99 is at 0.72, and so forth. So we get to the 91 strike, and it's got a delta of 1. As we go further out of the money, as we go to the higher strike prices on the calls, we naturally see our delta decrease. And the puts are reversed. We go to the higher strike prices, puts are in the money, we see our delta increase to -1. So if the stock gains $1, we'd expect our 110 put here. Let's go across the 110 put. If the stock moved up $1, we'd expect to see about a $1 decrease on the 110 strike put option. And as you go out of the money, of course, lower strikes, we see much lower delta, much lower effect of the change in our option price due to a 1-point movement on the stock. Now remember, this is a theoretical change. I'm going to jump over to PowerOptions real quick, and we're going to take a look at 2 little examples here of stocks I was tracking, just this 2 stocks that I'm actually trading. So let's go ahead and change our screen. Let me see what there we go. And I'm just going to go to the option chain for SWKS. And we're going to go to the call and put chain. So I'm just going to type in the main symbol there, and let's go ahead and go to the call and put chain. Now I'm going to go back to Friday. So I'm going to use some of our historical dates here. Let's go to September. And I just want to go back to Friday the 12th and see what our prices were for just sort of the at-the-money options. Okay, so this one we're not going to look at. We're going to look at the September 20 series. Okay, so we have 8 days left on our September 20 series. Let's call it it's stocks at 55.02 on Friday's close. 55 strike call had a price of 80 to 90. So let's call that 85 cents. And we have a delta of 0.51. Now, of course, we see our put bid price 75 to 80. Let's call that 75 cents, and we have a delta of negative 0.59. 49, excuse me, negative 0.49, 49 cents. So if we see a dollar movement, dollar increase in the stock price, we'd expect our call to gain 51 cents. We'd expect our put to decline 49 cents. Okay, so let's go forward to Friday. We'll just use the next button up here at the top. September 20th. The stock's down $1.02. We've gone from 55 to 54. So this went the reverse. This went down. So we would expect that our 55 call that we were looking at should have declined about 51 cents. So here's 55 call, got a bid of 45, ask of 50. Let's call that 45 cents. Okay, so the stock moved down $1. The option price was at 85, the call option, excuse me. We did have a price of 85 cents. Let me mark that there. I want to get a different pen color. Good. Okay, so this was at 85 cents with a delta, remember, of 0.51. So the stock dropped $1 and the option dropped about 40 cents. So close, but not technically there. It wasn't the exact number. And again, it's because other factors came into play. Now for our put option, a put option was, would have 75 cents. Now it's at $1.20 to $1.50. Let's take the midpoint there and call that $1.35. Remember, we had a delta of negative 0.49. So the option was at 75 cents. Stock dropped $1, so we actually gained about 49 cents. Well, we gained about 60 cents, right? The option went from 75 cents to 135 using the midpoint. So it was a little bit higher, so 0.65. And again, it's because other factors came into play in that situation. Let's use another example very quickly. We're going to go to ARRS. And of course, you can see why the reason I selected these two stocks is because they both moved in these time frames about exactly $1. And we're going to go to Monday. All right, so I want to see the Eris chain for the 15th. And again, I'm going to go to the October. This one doesn't have weekly, so we're going to go to the standard October expiration. So on Monday, the stock was down almost $1 from the Friday before. The stock's at $29.61. So let's take a look at the 30 strikes again, or the at-the-money strikes. 85 to 95 bids, so let's call that a 90-cent midpoint. And we have a delta of 0.46 on our call. With the put, we've got a bid of 120 and an ask of 135. So let's just call that 125 for now. We'll just call that 125. And we've got a delta of 0.54, negative 0.54. So again, if we have a $1 increase in the stock, we'd expect to see the call gain 46 cents and the put would lose 54 cents of its value. If we have a 1-point decrease, the put would gain 54 cents, the call should lose 46 cents. Let's take a look. Let's go to next. All right, so we're looking at the, oh, I'm sorry, let me go back one. That was strange. I'm sorry, maybe I was looking at the wrong one. Did I claim the wrong one? Oh, I did, I'm sorry. We were looking at the 30 strike. That's what I said, I'm sorry. Let's go to the current one, or the next. Let's go to September 16th, Tuesday. 30 strikes. Stock's up $1.30, a little bit more than $1. Our bid price on the 30 call, 155 to 165. So let's call that 160. Well, we gained 70 cents on that call, okay? So we had a delta of 0.46. Stock moved up a little bit more than $1. We gained about 70 cents. And the delta now, of course, has changed to 65. Regarding our 30 strike put, we had a price of 125 and a delta of minus 0.54. The stock moved up $1, and let's just call this, 72.5 cents. So that's roughly a decrease of about 52 cents, 53 cents, so that's almost exact. Okay? So again, why would this not have reacted directly to the delta? The call moved up in a value of 70 cents with a delta of only 0.46. Well, again, other factors came into play. Perhaps volatility, an increase in implied volatility. In addition to that, some factors regarding the at-the-money bell curve, which affects time value. We're going to talk about that in just a moment. And in addition to that, supply and demand. Okay, there's not a wide bid-ask spread, but the market maker might have had the ability to increase the price due to the demand on the option itself. Okay? So again, we just wanted to use this illustration to show that with all the Greeks, they're theoretical. May not see them change exactly, but we're going to see the value as well. All right, so the uses of delta for investors. Delta, remember the change in the option price related to a change in the stock price. The uses of the delta, well, a gauge of moneyness. Well, how far in the money or out of the money are we? A lot of investors use this as a gauge of the probability. And what is the probability that the stock will stay above or below the option strike price? And of course, the main use for delta, a lot of investors use it for, is portfolio or position hedging. When we talk about delta neutral strategies or portfolio delta neutral as well. Now, delta related to moneyness, of course, well, deeper in the money options are going to have a delta closer to 1. 1 for the call, -1 for the put. Out of the money options, those are going to have a delta of 0. Of course, remember the call options, the strike prices that are higher than the current stock price are out of the money. Put options that have strike prices that are higher than the current stock price are in the money. Well, to be honest, if we're going to trade a strategy, whether it's covered calls, our vertical spread traders, we had 73% doing the vertical spreads. Well, I can guarantee that most of you are trading out of the money credit spreads or in the money debit spreads. Well, you're going to be at the money, out of the money, or in the money based on strategy. Now, if you're a call buyer, so if you're buying for growth, okay, you're buying calls or buying puts, you may be buying for growth or buying for a large return. Most call and put investors, long option buyers, will buy in the money for growth, meaning they wanted to get a delta close to 1. So if I'm bullish on a stock, I'm going to look several months at a time, I'm going to go in the money. It's going to cost me a higher price for the intrinsic value and some of the extra time value, but I may be trying to get a delta of closer to 1. So if the stock moves up 1 point, I'll get close to a 1-point gain on my call option. Now, those who are buying out of the money options or buying speculating, hoping on a stock rise but don't want to put a lot of money in, you're going to buy out of the money, pay a low premium, and if there's a 1-point move in the stock, you may see your 20-cent option go up to 40 cents. So you made 100% on your investment, but it's lower cost, high leverage return. Okay, so but again, you know, in this aspect, if you're buying in the money for growth, well, you're looking for higher deltas, and if you're buying out of the money for leverage, you're losing lower. When we're selling for higher probability, okay, so we're talking about the vertical spreads. When I'm selling a vertical spread, looking for the higher probability, well, if I want my options to expire, and some of you doing covered calls may also be selling out of the money calls, hoping that the stock doesn't reach it. You want to generate a dividend-like income month by month by month, so naturally you're going to have a lower delta. And I said lower absolute for those of you selling out of the money naked puts, cash secured puts looking to buy stock at a discount. You're going to have a lower absolute value, but you're going to have a negative delta. Of course, if I'm hoping to get assigned as a form of the debit spread, I'm going to want the stock to be above both my strike prices in a bull call debit or below in a bear put debit. Or if you're trading in the money covered calls, hoping to get assigned, make a 1 to 1.5% return, change that each month, well, you're going to be in the money. So you're going to be having a higher delta. You're going to look for higher deltas in that case. And for those of you doing the neutral positions, let's say you're selling straddles, short strangles, or iron butterflies. I'm sorry, short straddles, or even if you're buying long straddles, hoping for an earnings event, well, you're going to be at the money, so you're going to have that delta around 0.5. And of course, your strangles, well, you're going to be out of the money, and iron condors, like the credit spreads, you'll be out of the money as well. So you're going to be looking for lower deltas on your short put and your short call position. Related to probability, it's the same thing. Some services will use the delta for probability. So if you have a call delta that's right at the money, you have a call delta of 0.5, you'll see a 50% probability of assignment. And of course, you go deeper in the money and you have a call delta of 0.75, well, you may see a probability of 75% above the strike price for assignment purposes. And then, of course, out of the money, you get a lower delta, maybe a 0.25, so you'd have a 25% probability above. And it's you know, the negative value, the reverse for the put options. Now, the problem with just using the delta for probability is that not all of the near-term conditions will be factored in. We use a different equation at PowerOptions. We actually take into account the average implied volatility of all the near-term options for our probability equations. Now, why is that important? Well, it's factors that are coming up such as earnings, pending patent lawsuits, or FDA approvals. If you have earnings coming up in the next 2 weeks, you might know that your stock may not have moved. It hasn't been priced in yet, of course. It's just stagnating. So you see a lower probability for a slightly in-the-money option. But if you notice, all the implied volatilities of those options started to spike. So the market's speculating a movement one direction or the other. You want to factor that in. All right, you want the implied volatility factored in without taking just the delta equation and saying that equates to probability. However, there's nothing wrong with doing that with delta. We just like to take in the extra factors of upcoming events into our equations for probability. Now, delta neutral, and if anyone is doing delta neutral, I'd love to hear from you. But the delta neutral positions, you want to keep the positive and negative deltas in a portfolio or on a multi-leg position around 0. It hedges the position or your portfolio against large market swings. The problem I've always had with this in my experience in trading is that the delta neutral positions, well, delta is ever changing. The stocks always fluctuate in price. Okay, some large cap stocks may not move that much, but you always see changes in the stock price. So delta is ever changing, which means you're constantly adjusting the positions to sort of keep in that delta neutral and close to 0 range. Profits are harder to come by, and with that many transactions to try to keep delta neutral, it benefits your broker. It might not really benefit you. But if anyone is doing successful trading, Ashish asks, can we verbally go over the probability screen of delta for puts? We'll do that when we go to one of our next option chains. When we come back to power options, we'll do that later in the presentation. We're just going to keep going here with a review of the Greeks, okay? But we'll take a look at that in a little bit, Ashish, I promise. Okay, so the delta neutral positions, again, if anyone's had success with those or if anyone's using those, go ahead and send me a comment in the question pod. I'd like to know how you're doing with it. I was never successful long-term doing it. It did hedge my portfolio, and it did hedge my positions going delta neutral, but at the same time, wasn't seeing the profits I was expecting by trying to do the different adjustments and different management, and a lot of my capital went into, not a lot of my capital, but a lot of my profits went into commissions. Okay, now let's talk about gamma. I want to talk about gamma next since we just reviewed delta. Gamma is the delta of the delta. All right, so it measures the change we'd see in delta for a 1-point movement of the stock. So a basic example, XYZ is trading at $50 per share. We look 30 days out to the October 50 call, and it's currently priced at $2. Well, it's the at the money, so we see a delta of 0.5. We may see a gamma value of 0.10. And what does that mean? Well, 1 day later, XYZ goes up to $51 per share. We go up plus $1. The October 50 call might now be priced at $2.50. So we have a delta now. The delta is going to change also. We see the movement of our option. We had a delta of 0.5, so we see our option increase by that 0.50, 50 cents. But now the new delta is 0.60. It's going to increase as the stock moves up for our call, and now the gamma might change to 0.08. So here we had a gamma of 10, and we see that that affected the delta. Okay, so the gamma is just an effect, the change of delta that we'd expect to see. These are typically smaller values. The highest gamma occurs at the money, and then the gamma value diminishes as you go deeper in the money and deeper out of the money. Here's a basic gamma chain again, looking at our Apple. It was fluctuating in price, and now it's at 186, so the 101 is still the at the money strike. We see our highest gammas here on the chain, 11, change in delta of 11 for the 101 call, and about the same for the put. But as you go deeper in the money, we see the values of gamma decrease. Now, the reason why, as we saw earlier, we go deeper in the money to the 92 or the 110 strike. We were close to a delta of 1 on the put and 0 on the call for the 110 strike. And we were close to a delta of 1 already and a delta of 0 for the put. So if the stock moves up 1 point, well, you can't have a delta of greater than 1. So there's not going to be much change in these deeper in-the-money options that already have a delta of maybe 0.98, 0.99, and so forth. Okay, and as we go further out of the money, there's also going to be little change in the price. You know, the 110's at 5 or 6 cents. We see a dollar increase. This might go up to 7 or 8 cents, where the 109 strike is right now. So we'd only see a small movement in that position of maybe only 1 cent or so, in the delta, I should say. Now, the uses of gamma for investors, again, it shows the rate of change in the delta. This helps with what-if scenarios. You can use Black-Scholes calculators to estimate what your option would be worth, but analyzing the gamma says, okay, well, if my stock does move up, my option is going to gain 50 cents by my delta, but what would I expect my delta to change to? So if it goes up another dollar, what would my new increase? Okay, the option buyers can gauge the change over time, right? And sellers can too. But we're talking about if it continues to increase in our favor, how much should I expect my delta to keep increasing? If I start off with a delta, let's say of 0.6. We can kind of estimate how long it would take my delta to get to 1 or closer to 1 based on the changes in gamma, and what gamma is projecting will change the delta over time. Those of you that do delta neutral portfolios or delta neutral hedging on your positions, you may also use gamma neutral. So you may try to make sure that the gamma is neutral between what your longs and your shorts are, your positive and negative deltas with calls and puts. Combining gamma neutral with delta neutral does help keep the portfolio positions more neutral and less subject to market swings in one direction or the other. But it's going to further reduce the returns that you'll see in the position because you're trying to constantly adjust gamma and delta, so you're making more transactions, you're keeping a zero board. So you're protecting yourself against large swings in the market, but you're also going to reduce what we call the alpha, or the return on the position as well. I wanted to do gamma second, even though it's not really considered one of the first tier Greeks, but just because it's related directly to delta. It's the delta of the delta. Now theta measures our rate of time decay. It's the rate that we'd expect the option to lose time value as time passes. Now those of you that are selling options, your covered call traders, our credit spread traders even, some of you doing collars and even the calendar spreads for your short option, you may look for a higher theta because you want a larger decay in your favor. Option buyers are going to probably look for a lower theta, but again, this coincides with other aspects of the market. Our time value and extrinsic value of an option is the portion of that option that is not intrinsic, that is not in the money. At the money options always have the highest time value. Okay, so we're looking right at the money, we're going to have the highest time value. Where we go in the money and out of the money options, we'll always have a lower time value. Okay, this is part of the ATM bell curve. In the ATM bell curve, we see our in the money zones here. If we go in the money, oh, that's a terrible one. Let me get a different pen here. Sorry, folks. Let me get something bright. All right, so our in the money options here for calls, let's say, and our out of the money options going across a stock price range here. The at the money will have the highest time premium. We'll have a higher price in the money, but it's going to be mostly intrinsic value. There's not going to be a lot of time premium, and we'll have a lower time premium as we go out of the money. And we just saw that with the Apple chain, of course, because we saw the out of the money options only had a 5, 6, 7 cent premium on their values. All right. Okay, well here's our theta chain once again. A little bit different, same kind of change. Remove the delta and the gamma, and now we're looking at the theta and time value. Again, our stock's around 101.15 during yesterday's trading day. Still calling the 101 strike at the money for the call and put. The time value, we have a $1.71 premium, and that equates to $1.57 in time value. And as you see, of course, we go deeper in the money, we have lower time value on our calls. Go deeper out of the money, you have lower time value. The out of the money options are all time value or extrinsic value. The theta decay, 0.77, is always going to be highest at the money. Okay, and it's the same for our puts. And we can see here as we go deeper in the money, we see a decrease in our theta. All right, so we drop from 7.26 cents, or this equates to 7 cents decline as time passes, to about 6.28 cents, 4.98 cents, and so forth. We get down to less than 1/1000th of a penny, about roughly. And the same thing going deeper out of the money. We'd expect, the 0.21, so we'd lose about 0.2 of a cent per day as time goes on. And our puts, of course, the same thing. As we go deeper in the money, higher strike prices, we see a decrease in theta because it's a lower theta. So we're going to have lower decay over time. As we go out of the money, we see the lower theta as well. Now, uses of theta for investors. As we just already talked about, the option sellers, if I'm just doing covered calls, maybe I'm doing naked puts, or even my credit spreads in theoretically, well, we'd want to look for a higher theta. We want to look for a higher time value decay to get the most of that premium decayed in our favor. But again, highest theta is at the money. Does that really make sense for a credit spread or a cash secured naked put? If I'm selling a bull put credit spread or a naked put position, I want higher probability, lower delta, which means I'm going to be out of the money. And of course, with the out of the money, means a lower theta. Okay, so we're going to have a lower time decay, assuming that the stock price and volatility remains the same. That's one thing about theta, is that it makes the assumption what you'd expect to see your option decay if the stock price, volatility, and the other factors of the Black-Scholes pricing model remain the same over time. All right. So that's what we look for theta is theoretically, again, if I'm selling options, I want the higher theta, but that means at the money. And based on my strategy, I'm probably not considering at-the-money options. If I'm buying options, sure, I want to have a lower theta, I want to have a lower time decay, so I probably am buying an in-the-money option or an out-of-the-money, as we already showed when we looked at delta, buying in the money for the growth to get that delta closer to 1, and buying out of the money if you're looking for a large leverage return to have a lower premium, and of course the lower delta as well. Vega, our next Greek in line, is the effect of a change in implied volatility. Okay, so this 1 point increase in implied volatility, what would we expect our option price to change? Again, let's look at our static example. XYZ stock is trading at $50 per share, 30-day out October 50 calls priced at $2. We see that we have a Vega of 0.5 cents, and the IV is currently 0.2839. And some of you on your services, you might see it displayed as 28.39. We display it as a full decimal, but you might see it as 28.39. So it's about 28%, 28.4% implied volatility. 1 day later, implied volatility increases to 0.2939. The stock doesn't move. Okay, the volatility changes, the stock doesn't move, nothing else changes. Yes, we lost some time, but in this case, let's say the IV increases to 0.2939 or 29.39, we'd expect our October 50 call to be priced at 205, okay, without even a movement in the stock price. Stock price stays at 50. With a change in implied volatility, we would expect the Vega of 0.5 to see our option price increase from $2 to $2.05. All right, now the Vega chain, very similar to what we just saw with the time value and with the theta. Vega is always highest at the money. A change in our option price due to a change in implied volatility will always be at the highest level at the money strike. Again, stocks at around 101, a little bit above. At the money strikes at 0.6. But those other options around it here with our single strike are also very close as well. You know, we see a change in the 100 strike of 6 cents for our call, the 102 at 6 cents, and so forth. But, you know, as we go deeper in the money with our calls, we see the Vega value get closer to 0. And as we go further out of the money, change in implied volatility won't really affect the option price, and especially if the stock doesn't move. If the stock's still trading at 101.24 and the volatility of the stock, say, went from 0.25, or let's call it 0.26 up to 0.27, we'd probably still expect to see a price of around 3 cents or 4 cents for this deep out-of-the-money call. We're not going to see a lot of effective implied volatility. It's also shorter term. Of course, puts, same factor. At the money option is our highest theta, and as we go deeper out of the money, below the current stock price, or in the money, above the current stock price with our puts, now we see an increase, a decrease in Vega as well. Now, the important thing for Vega, it's for implied volatility plays. Those of you doing long straddles, long strangles, even buying calls or buying puts, you're expecting a change in IV for earnings, okay, or another event coming up. As we mentioned before, aside from earnings, pending patent lawsuit judgment, FDA approval, you may be looking for an increase in implied volatility or a sudden movement of the stock because implied volatility is high. This is a double-edged sword. We're actually going to talk about this next week. Next week we're going to get deeper into this with a little bit with Vega and implied volatility. Our options concept presentation for next Wednesday will be implied volatility, the double-edged sword. Well, option buyers, if you're doing long straddles, long strangles, or just buying calls or buying puts, you fear the Vega or the implied volatility crush. Okay, and what that means is that if we buy into an option with high implied volatility, and then without the stock even moving, our volatility, let's say, drops from 0.60 or 60% down to 0.30 or 30%, we're going to see a massive decay in our option premium, our extrinsic value, without the stock even moving. And that's going to come back to haunt us as option buyers. And option sellers will fear a Vega rise. I might be trading a short put position, a naked put. We had our XYZ stock at 50. Let's say I sold the 47.5 October put, hoping that the stock would stay above it, or if it did drop below 47.5, I'd be able to buy the stock at a discount and keep the original premium. But if the stock doesn't move, it stays at 50, and all of a sudden there's an increase in implied volatility due to some news that came out on the stock, I may have collected 50 cents for selling that 47.5 put. But now that the implied volatility rockets up, and Vega, there's a high Vega increase as well, well, my option may jump up to $1 even though the stock hasn't moved. So technically, I haven't suffered a loss yet, but I have an unrealized loss on the position without the stock even moving. I have to pay back 100% of what I collected to close the position. Okay, so that's where we'd look for Vega, and how would we use as options investors is looking for the change in implied volatility. But how would the Vega affect that if we're expecting an increase in implied volatility by buying our options at the lower end of the implied volatility range, or if we're selling options at the higher end of our implied volatility range, what we expect is a decay if the option implied volatility or the implied volatility of the options fall in price. Rho we're not going to go too much into. All right, Rho measures the change in option price to a change in interest rates. It's not used that often. The one thing we really want to say about this is, in general, call premium is going to increase with an increase of interest rates. Put premiums are going to decrease. Okay, the Rho value is lower for shorter term options, so the nearer term are going to be less affected by a change in interest rates. And farther out options, the leap options, for example, are going to show the greatest effect with a change in the interest rates going forward. Okay. Oh, okay. Mike asked a great question. Mike, I'm going to get to that in just a moment. So we're going to wrap up with Rho here, and then we're going to talk about the other part of what I mentioned of today's presentation, and then I'm going to get that's going to directly relate to your question, Mike, about above or below historical volatility. Is the option price too high or too sell? I'm going to get to that in just a moment. All right, so here's just, again, basic chain for Rho. Now, this one might be a little bit confusing. It's very different. This is a shorter term chart. Okay, so we're looking at 9 days out again with our Apple example. You see here that the at-the-money options are kind of mid-range. They're not the highest, they're not the lowest, but the at-the-money Rho will be, just about average. But what we do see is that the Rho will increase for options that are in the money. So as we go to the lower strike prices on our calls, the Rho kind of gains a little bit. As we go in the money with our puts, the absolute value of Rho, or the negative change, increases. But as you go out of the money, as you go to the higher strike prices on the calls, Rho essentially gets lower. It has less effect. And same thing as we go to the lower strike prices on the puts, to our out of the money puts, Rho has less of effect as well. And let's take a look at the long chain here. Further out in time, we're going 485 days out in time now on our Apple chain to January 2016, our leaps. Well, look at that increase. The at-the-money options are Rho at about 0.59 instead of 0.02. All right, so a change of 50 to 60 cents in your call premium if the interest rates increase. But again, as we go in the money, we see now that the Rho is going to increase for our calls, and the absolute value of Rho increases for our puts as well. Of course, a higher negative value with the in-the-money options. And as we go out of the money on the calls to the higher strike prices, our Rho decreases. And then our Rho increases here, or decreases as well as we go out of the money for the put options. Okay, but to me, uses for investors, I don't know many people who attempt this, but if you're planning on a change in interest rates, you could get a benefit of buying a long-term leap out in time on a stock, ETF, or index perhaps. Those of you who sold long-term options, I have several PowerOptions subscribers I talk to on a regular basis who are selling naked puts deep out of the money, 8 to 10 to 12 to 15 months out in time to get a higher premium, and they just let that sort of sit. It allows you to go, maybe 15 to 20% out of the money, still get a reasonable premium. But if the interest rates change, if the interest rates do increase, those of you who sold those long-term out-of-the-money options, you may see the price increase. Even though the out-of-the-money options, as we saw, they have that lower value, but it's important to know that if the interest rates increase, that's how it affects your maybe deep out of the money long-term short puts. Short-term options are affected by a change in interest rate, but not much. We saw that 9-day out trade would only have effect of 1 or 2 cents on the options with an interest rate increase or a 2-cent decrease on the puts with an increase in the interest rates as well. All right, so quick recap. Delta, change in your option price due to a 1-point movement in the stock. In the money options are going to have a delta close to 1, -1 for puts, +1 for calls. Out of the money, expected to get closer to 0. At the money, be around 0.5. Gamma is the delta of your delta. The at-the-money options have the highest gamma. The lowest gammas are seen out of the money, in the money. That's the same with theta, our time decay. How much can we expect our option to lose per day for a one-day movement or as time passes? And of course, that assumes that the stock price stays the same, the volatility stays the same, and everything else. That's what we'd expect to see our theta decrease. Vega is your change in your option price due to the IV. And again, it's the highest in the money, and the lowest when you go out of the money or in the money. And then the rho is just change in interest rates. It's lower for the short-term options. It's higher for the long-term options. And expect the calls to increase in price with a change in interest rates and the puts to decrease as well. All right, so a lot of that verbiage. We avoided the math, of course. We tried to use common layman terms, but what does this mean? We've outlined just the basic concepts and how some investors might use them in different situations. But it's the structure of the trade in your trading plan will already have your Greeks factored in without using them. Okay, and this is why we say that we're going to discuss the Greeks today and why you may not need them. We're going to navigate back over to PowerOptions, and I'm going to look at the chain again real quick to answer Ashish's question before we get into some of our searches here. There we go. Okay. And what I want to do is change the columns on the PowerOptions change now. He wanted to ask about probability. So let me go ahead and we'll use the Apple example again. What I'm doing is going here to the choose columns feature for my the calls and the puts, and real quick we just want to select the probability above and probability below. So I'll do that for the call, and I'll do that for the put. I think what Ashish wanted to know is how is that related to delta on ours? What's the difference? Okay, let me save and return, refresh our page here. And again, I'm going to go to the current, and we're going to go to Apple for that 9-day out trade we were using for most of the day. We still have the ARIS example here, but let's use AAPL. And I just want to see the September 20th. Okay, so let's go with the at the money. Okay, so it's not too far off, and I didn't expect it to be, honestly. Here's our 101 call. Our delta is at 0.49. Okay, so with a little, it's very close, of course, but the probability above here is 40. Did this give me, oh, sorry, 1 second, folks. I just wanted to check something real quick. Just want to look at the small chain. Oh, sorry, folks. Hold on 1 second. Sorry about that. Wow. Okay, there we go. It just disappeared on me. Okay, sorry about that. Let's go back to square one here, folks, where we were. All right, so looking at the smaller chain now, a little bit different. The 101, let's keep it at the money. It's 192, so we're at the 101. A delta of 0.49, and we see a probability above. We have 48.3. So it's not exactly 0.49, but it's not too far off. And as we go higher, 15 and 15, okay, 0.6 and so forth. It's kind of close, but we are factoring in other factors. And of course, the reverse now, on a call, if I have a probability above 48.3%, then that would equate to a probability below of 51.7%. This one's pretty close. For our 100 strike again on the puts, we have a delta of negative 0.51, and we see a probability below of 51.7%, or a probability above 48.3. And of course, let's go deeper in, 32, and a probability below 32.1. So they're close. It's just a little bit different, and it's not rounding. It's actual. Some equations you'll see a little bit more. If you look at a position that has earnings coming up, you'll probably see a wider range as well. Okay, so wanted to talk now, again, let's go back to where we were, and Mike, I'll get to your question in a minute. We want to talk about trade structure. And let's take those of you doing, 73% of you doing bull put spreads. We're going to run some quick searches here on our highest ranges. All right, so let's go to bull put credit spread, and I'm just going to go into search. Anytime I go into search, this just pulls up the default criteria that we have below. I'm just looking at initial values, and there's 78 total results. What I want to do is talk about trade structure and your trading plan. I'm interested in trading bull put credit spreads. In a bull put credit spread, we sell an at or out of the money put. We buy a lower strike put that's deeper out of the money. So what that gives us, of course, is we're going to receive a credit for that transaction, Max loss is the difference in strike price. The stock falls below the lower strike price. I want the stock to stay at or above the higher strike put that I sold. And I want to make sure that I'm receiving a good credit, and I want to find neutral to bullish stocks, naturally. It's a bull put credit spread, so I got to factor that in to my equations. Well, with just that in mind, let's go ahead and clear out the filters. And we'll keep it relatively short term for now as far as the options go. But before we go into the options criteria, let's talk about the stocks. I'm going to go into the stock fundamentals. And what are some of the things that I might consider for a bull put credit spread? Well, I'm not going to worry about stock price. Okay, I don't have to worry about the investment amount because the difference in strike price is going to be my margin. It's a leverage trade. I don't have to worry about that right now. Things that I might look for personally is that I want to see stocks that have shown good growth and good management over time. So I like to use a field for my bullish strategies: covered calls, naked puts, bull put credits, bull call debits, standard collar positions, calendar call spreads, whether they're horizontal or diagonal. But I might look for stocks that have shown a growth in earnings, an earnings per share growth of at least 5% from last year to this year. Now at the same time, I like to keep my PE ratio within a relative range. I don't like to see a price to earnings ratio that's way out of bounds, that's too high. I may want to avoid fly-by-night companies, things that have a higher volatility. Now, of course, we talked about the higher volatility and the higher theta. That works great when you're selling. But when I'm doing a credit spread or even a naked put position, these aren't positions that we want to see stocks that are fluctuating wildly. We don't want to see a lot of implied volatility. Again, we're going to go back to that next week with the implied volatility double-edged sword factor, okay? The market capitalization here, and Bill asked, how do you know whether into 5 or 0.5? If you hover over the field, any of the filters on the search, Bill, you'll get a definition of that, and as well as how it's measured. So market cap is one of those ones that we measure in millions. So if I just wanted to look for mid-cap stocks or greater to avoid the small-cap stocks, I'm going to want to put in a value of 2,000 to blank. Okay? All right. Now, anything else I might look at here? Absolutely. My risk in a credit spread is if the stock drops below the lower strike price in a bull put or goes above the higher strike price in a bear call. And of course, reverse for the debit spreads where you're going in the money. But in this case, if I don't want any surprises, I'm going to make sure that here in the Fundamentals tab, I'm going to avoid stocks that have an earnings date between now and expiration. Oh, Bill, yeah, if it's measured in a percent, it's just a static number. It's not a decimal. Okay, so if you see percent earnings per share growth, it's just a static number. The market cap here, it shows us the values that we'd want to enter, as it will for the average stock volume that we're going to do in just a moment as well. So anyway, back to the fundamentals. I'm going to select the earnings date not between now and expiration. Basic technicals. What might I look for here on the technicals as well? Well, I'm not going to worry about historical volatility as it equates. We talked about implied volatility in relation to the Greeks and the theta. I'm not even going to worry about the Greeks or the volatility in this equation. The only thing I might want to look at here is the average stock volume, which is measured in thousands. So if I just wanted to see stocks that have a good average stock volume of maybe greater than 750,000 per day over the last 90 days, I'll put that in. What am I looking for? I'm looking for stocks that have shown good management, good earnings, and of course have good liquidity. In addition to that, well, I might tend to follow the trend. So in other words, here in a bull put credit spread and the simple moving average field, I want to look for stocks that are trading above their SMA 50. All right, so what do we want to see for our stock? Just our stocks alone. I want to see stocks that have grown in earnings at least 5% from last year to this year. We see that on our active filters. PE ratio between 0 to 50. Market cap, just look for mid. I was looking just for mid to large cap stocks. I'm avoiding expiration. And I want to see some good liquidity on my underlying security, some good volume. Don't want a fly-by-night company. And I want to see a stock in an uptrend. Okay? That's all we're putting in for the stock, some very basic criteria. Now let's go to our options. Now I'm going to look for shorter term positions, okay? So we're going to go maybe just 10 to 15 days on time. Let's stick with weeklies, but we can change it to October in a minute. So for right now, I'm just going to look at all months, and let's put in 5 to 11 days out in time, okay? I just want to see next week's expiration, not this week coming up that only has 3 to 5 days. I'm going to go further out in time. I'm not going to worry about implied volatility, but to answer Mike's question earlier, he asked, is there a way to determine if IV is above or below historical volatility? Is the option priced high to sell or low to buy? in every search, and we're doing this with the spread positions, you have a filter here where you can screen specifically for the implied volatility of the sell option and the buy option. In the single option strategies, we can look at the % implied volatility range, and I'll bring up that when we look at covered call search next. But I'm not going to use these filters right now. Net credit, okay, we're going 5 to 11 days out. Well, reasonable net credit might be something. Let's start off with just 20 cents, okay, 20-cent premium total for selling our put and buying our put. Now, what do we know when we're doing a bull put? Well, in addition to knowing that we want a premium, I'm going to keep my strike differences at 5, okay? I'm just going to put in a strike difference. You can put in less than or equal to or greater than or equal to. I'm just going to put my strike differences equal to 5 points for right now to keep things simple. But what is the other factor that we know about these positions is bull put credit spreads? Well, I want to be out of the money because I want to have the higher probability of my spread expiring worthless and working in my favor. So I'm going to go ahead and put in a probability here of at least 75% or more. That's a good range. That's a common range of what most of my spread traders look for. We want to be out of the money. We want to be below the current stock price. We want a probability of 75%. I don't have to put in a low delta for my short option of less than 0.3 or less than 0.2 because the probability takes that into account. I don't have to put in a range I want to see in or out of the money because the probability is going to force that as well. But let's just talk about the last thing I want to put in is some liquidity. Probably want some options that are showing good liquidity, so we're just going to put in a basic option volume today of at least 10 contracts, and I want an open interest of at least 100. All right, so I'm not looking at anything for implied volatility. I'm not putting anything in for my % time value or theta decay as well. I'm not looking at the deltas. I'm not looking at the Black-Scholes ratio either. I'm looking at basic criteria of what I'd want to see. I want to be within the short term, 5 to 11 days out in time. That'll show us next week's expiration. I want a minimum credit of 20 cents. I want a strike difference of 5. Of course, we could have set that to between 5 and 2.5 or any range you wanted to. But I want a probability, of course, of greater than 75%, and I want good liquidity on my options, and I need to look for stocks that match the structure of the trade, the strategy itself. I'm looking for neutral to bullish stocks. Let's go ahead and submit that search and see what we get. All right, so we only have 2 results. But number 1, that helped us save time with our options research and analysis. But number 2, let's take a look at something else. I'm going to go into choose columns once again. And this isn't a great example, but we're going to do other ones as well. So what I want to see now is I want to see my short option delta, my long option delta, and we could look at the open interest and so forth. But anyway, I'm just going to look at the sell implied volatility and the buy implied volatility, and we'll put in the implied volatility ratio as well between the 2 options. That's actually sort of more important when you're looking at a spread trade. But let's go ahead and save those and take a look. Now, this we'd expect to see, okay? And the implied volatility, relatively close range, without putting in screens for implied volatility. As we saw, of course, we could look at the Vega. It would be very similar. The Theta, the time value of these 2 options would be very similar. And our deltas, our short option deltas, are pretty close to the same. Of course, it's a limited view. I understand that. But our deltas are close to the same. If you create a trade and you have a trading plan of what type of stocks you want to look for and a reasonable premium you're looking for, the reasonable probability, the Greeks are not necessary. You don't want to get stuck necessarily in all that verbiage and all that terminology of trying to figure out what Greeks you want. You're already factoring them in. Was this basic search for bull put credits really advanced? Well, I maybe put in some advanced criteria for earnings per share growth, looking for stocks that have grown in earnings, because I feel that's going to drive the stock price going forward. A PE ratio, relative, mid to large cap stocks. I don't want to see fly-by-night companies, and I want to avoid positions that have an earnings between now and expiration. I wanted stocks that were in an uptrend because I'm doing a bullish position. If we were doing bear call credits, I would have reversed this. And of course, good liquidity on the stock, 750 or greater. And then we just put in some basic criteria. I know I wanted to go out to next week. I wanted to look for a minimum premium of 20 cents. I wanted some good volume and open interest. Shouldn't be a problem with those weekly options anyway. I want a probability of 75. But not only did we narrow this down a lot, but our deltas are pretty much even. Without using delta, Vega, Theta, we're already screening for them if we have a reasonable trading plan in place and know the proper structure of the trade. Now let me change our options expiration time frame. Let me go to October so we can get a wider range. Of course, there's only 389 stocks right now that offer weekly options. So let's, sorry folks, let's go out to October, 30 days away. We're going to get much more results here, but let's just take a look at the top 20. Didn't get as many results as I thought. I thought we'd have many more, but we are heading into an earnings season. But take a look. Again, the delta of our short option is within a tight range without screening for delta. The implied volatilities are in a tight range from 0.17 to 0.42, which of course is going to affect the other Greek factors as well. So without even screening by the Greeks, we technically are. You know, this range of 0.08 to 0.24, that's a tight delta range for out-of-the-money options. Let's do a very similar screen with covered calls for the, I'm sorry, second place, 61% of you doing covered calls and naked puts. And again, you know, not to beat a dead horse, but I'm going to use the same exact criteria for the stock that I use in a covered call that I'm going to use for bull put credit, naked put, and calendar spread and bull call debit as well. So let's go ahead and enter those criteria again. First step, I'm going to clear out the filters. I'll start off in the fundamentals. Now, I do have to change one thing, and you'll likely change one thing as well. We could leave it open, but I'm going to change one thing. For a covered call now, or for a naked put position, a cash-secured naked put, I now have to consider stock price based on my account size. You know, we had a gentleman earlier who said he'd been trading actively for a couple years at IB with a $500,000 account, so a stock price range might not be too much of his trading principle. He may be able to afford to go into $200, $300 stocks if he so wanted to. But for my account size, I'm just going to keep a general view first. I'm going to go, let's go $5 per share, to $85 per share for stock price. But my other criteria, I want a 5% earnings per share growth. It's a measure of percent. So we're going to put in 5, value of 5. PE ratio of 0 to 50. Keep that in a relative range that matches my needs. Market cap, greater than 2,000. I want to avoid the small cap stocks in this situation. Again, I'm going to avoid earnings between now and expiration. We're going to leave ex-dividend date alone for right now. Let me go into the stock technicals again. My average stock volume, 750,000 shares per day. And I want to see stocks that are currently trading above their SMA 50. Now let's go into the options criteria. And let's just go static October. Standard October expiration, roughly 33 days away. And what would I normally look for now in a covered call? I can screen by time value, percent time value. Mike, you had asked earlier, you see the single option strategy. I can screen specifically by implied volatility over historical volatility or implied volatility over SIV. And what we're talking about here, IV over HV, if you wanted to look for options where the implied volatility is above the historical volatility, I'd look for a range of greater than 1. Okay, if I wanted to look for options where the IV is lower, it looks like theoretically an underpriced option, I'd use a range of less than 1 or maybe less than 0.95, something along those lines. And percent implied volatility range I'll get to in just a moment as well. But what am I focusing on with a covered call? I'm buying stock and I'm selling a call against it. I know based on my account size what stocks I'm limited to trading as far as price goes, but in addition to that, I know my commission costs, so I do have a minimum option premium I have in mind. Let's say on average I trade 300 shares or 400 shares of a covered call or cash secured put, so I know that I might want a minimum option bid price of at least 50 cents. But as part of my trading plan, that premium I receive, I'm going to want to make sure that it matches my goals. So if the stock is assigned, it does go above my strike price and I'm called out, well, I might want that return to be a minimum of 3%. In this case, we'll scale it back down to a minimum of 2.8% if we're assigned. Percent if unchanged, if the stock stays at the same price between now and expiration, I might want a minimum return on that of 1%, but let's narrow it down to just 0.5%. And the downside protection. You know, what is the option premium divided by the stock price? Shows us how far the stock can drop before we're losing money on the covered call position. I am going to keep that at 3%. Now again, I'm not going to use a range in or out of the money. And I'm not going to use delta to force it to be at the money or out of the money options or anything along those lines. We're just going to keep a basic simple principle. This is my trading plan. I want a minimum 2.8% if assigned for my trading goals. I want a 3% downside protection. I want a minimum of 50-cent option premium. And again, I want some good volume. I want to see 10 contracts traded today at an open interest of at least 100. Let's go ahead and submit that search, just those basic views. Okay, so 19 results, and again, this is affected by the earnings date because we're avoiding stocks that have an earnings between now and expiration. Well, I show the returns here, my percent downside protection, my percent if unchanged, and my percent if assigned. Now let's go back. What are we not showing here? We're not seeing any of the Greeks. We didn't use that on our filters. Let's go into choose columns. And right now for our option-related columns, I'm going to select all of them. I want the delta, gamma, theta, vega, rho. And we'll scroll down here. Let's just submit and save those columns. Let's take a look at our top 20 results here, our top 19 results. Start off with our delta for our covered calls. Delta range here. The highest is 0.62, slightly in the money. Canadian Solar's at 39.36, 38 strike call. We have a delta of 0.62, and it looks like our lowest is 0.35. So without even screening for delta, I've got a very narrow range of 0.35 to roughly 0.6. Oh, there's one here. I'm sorry, there's one that's 0.67, but that's still a tight range. Now, I know that most of these are going to be slightly in the money, slightly out of the money, or slightly at the money. Okay, why? Well, because of the filters that I put in. The returns that I was looking for dictated that we'd see mostly at the money options. Looking for a downside protection of at least 3% and a percent of a sign of 2.8% on those types of quality stocks that match what we want to see for a covered call position, you're going to have a relatively lower volatility, but at the same time, you're going to have about a 3% return at the money where that time value is the highest and the theta is the highest as well. What if we wanted to change this? How about those of you that are doing covered calls that are deep in the money, you're hoping to get assigned and just take that return, and from that return, take the profit and then roll into new positions for the next month? Well, you're probably looking for a higher downside protection of around 5% or so because you're collecting intrinsic value and time value. But you're also going to have a lower percent return. So let's call this at least 1.2% on the position with a downside protection of at least 5%. Percent of funds change is going to lower to 0.2. Okay, so 2% time value essentially. We're going to keep the other criteria because we still want the same kind of stocks in a covered call. We're just going in the money for a greater downside protection. Let's go ahead and submit that search. Okay, so now we have much more results here. We've got 21. But again, what would we expect when we go in the money and we look for a higher downside protection and know we're getting a lower percent return? We're going to see higher deltas, but on our first 20 results. See a high delta, 0.77, looks like it's the winner for our highest delta, and the lowest of, there's a 0.83. My apologies, I missed that one. So 0.83 is our highest delta, deeper in the money, and about 0.50 is our lowest delta. 0.49, 0.50 is our lowest delta. So without using delta, I've restricted this to a tight range of a delta difference of 0.3. Okay, what about our other Greeks? And we would have seen the same on the other at-the-money screen. We didn't. Well, gamma, range of about 0.6 to 0.12. Okay, 0.4 here to 0.21. That's the highest range of gamma. So again, if I'm selling a covered calls, we know how the gamma is going to change the delta. Well, if I'm hoping to get assigned, I just want to stay in the money. I'm not too concerned about the option price. That would come into play with maybe an out of the money if I'm looking to buy it back, okay, which more cheaply. But we're in a tight range of gamma. Our theta, our time decay, 0.5 looks like it's the highest. And right below that, it looks like just a little bit below that, 0.149, and 0.10 is our lowest. So it's a pretty tight range of our theta decay as well, without even using it. Vega, we already talked about, and rho, of course, we're not going to see much difference. There is one here that's I'd consider high. This is a 0.4 rho on First Solar. The expectation, if there's a change in interest rates, we see this gain 4 cents. But again, the shorter-term options aren't going to be as effective as the longer-term. We focus more maybe on rho if we are buying leap options or selling those leap options further out in time to see how our prices might be affected if the interest rate increases. And again, just Vega, not much expectation on this one either. The change in implied volatility, we're at a range of 7 cents to 1 cent, I think I saw. Yeah, so we're still in a tight range of how those options would change with a change in implied volatility. So without even using the Greeks, we've restricted the Greeks to tight ranges based on a proper trading plan and looking for stocks, the proper structure of the trade, the correct stocks we'd look for in a given strategy, and a reasonable expectation of return, downside protection, and with naked puts, we talk about the percent to break even as well. Now, another question that came in is, well, we had mentioned earlier about using the, we were talking about the change in implied volatility, how we wanted to avoid a Vega crush or an implied volatility crush. And this will come into play for those of you doing long calls and long puts, but also other strategies. And in those searches, what you'll see is the percent implied volatility range filter. And what this measures is where your option's implied volatility is now compared to where it has been over the life of the option. So for those of you who buy options, I'd suggest, even if you're buying married put positions, radioactive trades buying put options far out in time to secure your stocks, I suggest that you use a lower percent implied volatility range, maybe less than 50% or maybe less than 60%. Because if you buy an option that's at 100% implied volatility and 2 days from now it reverts back to its average and drops back down to 0.5, you're going to see a massive decrease in your option price without the stock potentially moving at all. And for those of you that are selling, well, you may want to sell at the higher range. You may want to look for an implied volatility range of greater than, let's say, 50% or 60% or so that you're looking for the options that are at the higher range of the implied volatility range. The hope there, of course, theoretically, is if the implied volatility reverts back to normal, your option premium will decay in your favor, and you can buy it back cheaply, potentially early. So for Mike, when you asked about not only the IV over HV to look for overvalued or undervalued, but the range of implied volatility, you'll be able to see that in the various option strategies using the percent implied volatility range. And that, of course, is going to relate to the Vega as well. And we talked about if we have a higher percent implied volatility range, an option that's near the peak of its implied volatility, how will Vega affect that, and how will Vega be affected as well? All right. Okay. All right. Oh, Francisco asked, where can we find your recommended parameter? Well, they're already available in most of the default searches. For example, we look here, we have some default searches in PowerOptions called broker recommended. We started off with the initial values on the bull put credit spread. Most of our default criteria have some of those factors we showed today already in. Let's take the initial values at the money. It's a larger search range. There's 88 results. But what are we looking at here? Well, we put in broker recommendation on this one, stock price above the SMA 50. We look for stocks that have a greater earnings per share growth of at least 7%, price to earnings between 0 to 70, and Ernie likes to use a price sales of greater than 10. And then you have, of course, the ranges of the downside protection, percent of assigned, and option bid price. Some of the liquidity is not there for the stock or for the options, but they're all things that you can enter in. But Francisco, at any time, if you ask what are your criteria that you would use for a bull put credit spread, a bear call credit spread, well, they're essentially the searches that are already available for you. Ernie and I created these default screens. Ernie mostly did the initial values, the ones here in the search. Every strategy also has a sample search menu that you can use. These are themed searches. So for covered calls, you have the broker recommended, covered call search for ETFs, new stock highs. And if we went, again, let's go back to bull put credit spread, and we looked at our sample searches. There's one on using ETFs, one on using 5-star stocks, very similar to the criteria I just used on the scratch, and then one's using for large cap stocks as well. So these are the searches. If you called me up and you said, what criteria would you use as a starting point to identify positions? Well, they're already available in the search and sample searches. Ernie, you created those searches based on what he would look for as a starting point for his positions, but then you tweak them based on what you want to see. If you want higher probability, if you want to look for higher return, you want to make sure you're avoiding earnings, just click those in. So that's where you'll see those, Francisco, as well. Okay, and of course, to follow up with that, Daniel's question, can we watch this webinar later? And Larry's question as well, yes, I am recording this presentation. I'm going to hope to have it posted around 4 o'clock this afternoon Eastern Time, I believe. Oops, that's not the wrong, sorry, folks. I apologize for that, and we'll send an email out to everyone when the webinar, of course, is posted. All right, so let's just sum up for today. If anyone has any last-minute questions, go ahead and send those in to us. Let's talk about the Greeks one more time. The Greeks are useful to know. Don't get me wrong. I'm not saying that you shouldn't use them. I'm not saying you shouldn't know what they are. But what we really don't want you to do is get caught up in all the terminology and the quagmire of sitting there trying to go through all these equations and go through all these examples and all this discussion of evaluating how is my option price going to change for a 1-point movement of my stock. Oh, well, my delta is going to increase, and that's going to affect my gamma, and then if theta doesn't change this way, then I should be okay with the theta decay as well. How would Vega change with a 1-point movement of the stock? I know my delta is supposed to go up, but now we know Vega is going to lower because of the change in implied volatility, so how is that all going to work hand in hand? The more important thing is the structure of the trade. We only looked at a couple things today, bull put credit spreads and covered calls, but later on if you want to schedule a coaching session or if you want to go through some other examples on some other searches, and how if looking at the basics, even the default searches that we mentioned to Francisco there, you take a look at those and you'll see when you add in those other criteria such as delta, gamma, theta, and vega, you'll see you're already in a tight range without actually screening for those positions. Everything goes hand in hand. But there's nothing wrong with using the Greeks. I have a fairly large contingent of investors who are trading credit spreads with power options, and they came from a previous course that they took where the recommendation was to only enter bull put credit spreads when your short option delta is less than 0.2 for a call, or reverse, greater than negative 0.2 for the put. If you want to use the Greeks, we've got you covered. And if it's not broke, don't fix it. So if you're using delta in your screens right now, you're using theta as part of your decision-making process, you're using gamma, continue to do so. But if you're just getting started and you're getting sort of confused with all these terms that are thrown out, your broker may also host webinars teaching delta, gamma, theta. The Greeks are good things to know. They're good things to plan your what-if scenarios as time goes on to realize how your option might change and what you might expect to see as far as growth or decay in your option going forward. But again, if it feels like it's too much for you, in my honest opinion, you don't necessarily need the Greeks to trade effectively. They're good to know. They're good to use. I'm aware of what my delta is when I enter a position, whether it's a protected position or a speculative spread trade that's out of the money. But at the same time, you can, if you properly develop a trading plan and a trading structure, and you're following the reasonable expectations for a given strategy, whether it's a credit spread, debit spread, or iron condor, covered call, naked put, for example, you may not need to get too deep into the Greeks and too confused by all the terminology. The trading structure will satisfy that for you. Now that being said, all that being said, we did have a fair amount of our investors today looking at calendar spreads, diagonal and horizontal, and some of you even mentioned through the question pod that you're doing long straddles and long strangles, or some people refer to this as a short and long strangle combination, where they're selling a short-term strangle and they're buying a farther out strangle. Buying a put, buying a call at out-of-the-money strike prices further out of time and selling one's near term. That's really a double diagonal, okay? You can call it, someone is teaching a class out there or a strategy out there that are calling it the short and long strangle or some phrase like that. It's really just a double diagonal, whether it's a horizontal or whether it's a diagonal spread. But that's really what you're looking at. I got to be honest, when I'm trading my calendar spreads, I still trade diagonal spreads with a small portion of my account from time to time. I am paying attention to the delta ratio between the two options and maybe even the implied volatility ratio as well, which relates to theta and vega, of course. And for the long straddles and the long strangles, I want to be aware of what my delta and my gamma are if I'm buying a straddle or buying a strangle, speculating on a market movement. In other words, speculating on earnings. We've got earnings coming up in 2 weeks. I may look to do, actually I'd want to be 3 to 4 weeks out, but I may look to buy an out-of-the-money call and an out-of-the-money put that are 2 to 3 months out in time, but I want to know my gamma and my vega and my delta because I want to be aware of what's going to happen to those options. When earnings released, we may see a swing in the stock one direction or the other, but I have to pay attention to vega because once earnings comes out, what's going to happen? That volatility, the implied volatility of the options that existed in anticipation of the earnings event are going to crush. And I have to be aware of that and aware of how that's going to affect my strangle or my straddle position. So all that being said, some of those more advanced strategies, the Greeks are definitely more important. Your calendar spreads and the straddles and strangles playing an earnings event, or even if you're trying to play a pending patent lawsuit one direction or the other, or an FDA approval. Of course, those are always tough because the option premiums are so high because the implied volatility is so high. It's hard to make a good return on some of those positions that have an FDA phase 2 or phase 3 approval coming up when you're buying the calls or buying the puts that expire, of course, after the event is supposed to be released, or the approval rating is supposed to come out for those positions. All right, well, I want to thank you again, ladies and gentlemen, for joining me today. Once again, if you do have any questions or any comments, just send me an email anytime to support@powerop.com. Of course, you can also call us during market hours. You can reach us at 302-992-7971. And of course, there's a contact links at the bottom of every Power Options page. Just go to powerop.com, or if you're logged onto your Power Options account, you'll be able to see those as well. All right, so I hope to hear from you if you have any questions or comments. Next week, we're going to have another webinar available, another concept strategy available. We're going to get a little bit more into Vega, but we're going to be discussing the implied volatility, what we call the double-edged sword of implied volatility as it relates to options vesting. I do have a question that came in at the end here. Let's see here. Sorry, this is from Ashish. On spreads, say bull put credit spreads, how does the change in strike differential to higher numbers, implying a change in delta ratio, impact your thought process? Well, it doesn't. It doesn't. Okay, so the change in strike differential, so if I go to higher numbers, if I go to a 10-point spread, or if I'm using the indexes and I go to a 20-point spread, what's that going to change? Well, that's going to affect, naturally, my net credit. I'll be able to get a higher net credit, but at the same time, it's going to affect my return because my margin requirement is going to go up from 5 points to maybe 20 points or to 25 points. So we go higher differential, have a higher margin, might get more premium, but I'm still probably going to end up with a lower return because of the increase in margin amount. But in relations to delta ratio, with my bull put credit spread, you're asking how does that affect your thought process implying a change in delta ratio? How would that change? Well, we'd have a higher delta ratio. Right? So if I did a 5-point spread, we know what our short option delta might be around 0.3 or 0.4, and then our long option delta on a 5-point spread might be about 0.2. Okay? But if I go further out, if I did a 20-point spread where my short option delta is at 0.3, well, 25 points out, let's say on a larger price index, my implied volatility of my delta, excuse me, folks, of my long option might only be 0.1, for example. So in that case, what we end up with is we're going to have a much higher delta ratio, and it's in our favor, but it's not. It's actually reversed against us. See, in that case, when we have a delta ratio of 0.3 on our short option, 0.1 on our long option, if the stock does start to move down on our bull put credit spread, well, what do we know? We know our option, theoretically, our short option that we sold, which is really the pivot point, it's the hinge, it's the one I'm really focused on, is gaining about 30 cents for every dollar the stock is dropping to start with, but delta's ever changing. That further out option that I bought, that I would look to sell to close if my position is in trouble, is only gaining 10 cents for every 30 cents I'm technically losing on the short option. So the argument could be made, Ashish, that keeping a tighter strike price range means that as the stock drops, your short option's working against you to, let's say, the tune of 30 cents or 40 cents, but if I'm only 2.5 or 5 points apart, my long option might be gaining 20 cents against that. Whereas if I went really far out, I'd get a better credit, absolutely. We'd have a higher margin, but I might be only gaining less than 5 cents or 10 cents on that long option to counter the loss I'm technically taking on the short option. So that's how one might view that as far as the delta ratio goes with a credit spread. But in all honesty, I just gave you my thoughts on how I would answer that and how I would look for it in my mind. I may not want that long option to be so far out of the money that it has such a low delta that if the stock starts to drop against me, gain in that long option, the option I bought, is not gaining against the short option as well as I'd like it to. I might be taking a larger loss on the short option. It's not being countered by that long option as such a small delta. But in reality, I already have my trading plan set for my credit spreads, and in my trading plan, it's already dictated to me what I'm willing to put up as my margin requirement, and that forces me into an ideal size trade for my spreads where I know that my spread ratio is only 5 points or maybe up to 10 points based on my margin requirements and based on my personal trading plan, not so much the delta ratio. It still has to have the net credit I want, still has to have the probability I want, also still has to have the difference in strike prices I want to keep the margin within the range that I want to see, for me personally. All right, so I hope that sort of answers your question there regarding delta ratio in relation to credit spreads. Delta ratio to me mostly focused on positions such as the calendar spreads, and occasionally if I'm doing a long straddle or a long strangle, speculating on a market movement with earnings coming up as well. All right. Well, ladies and gentlemen, I think that's going to wrap it up for us today. I want to thank you for joining me for today's